right? So we had a quite an interesting market today, right? Because of CPI. CPI just slightly went down, right? So the market was extremely excited about that. But remember, guys, when I always tell you there's supply zones and demand zones that dictate where markets go, and we hit that supply zone, earlier in the month. We rejected it and we hit it again today. So we had this big gap, and price opened, at the recent highs, right about there, and
Yeah.
then it just didn't want to go up. It just kept collapsing. It wanted to close this gap. And why? Because we have this supply zone that's acting as a strong resistance. The reason supply zones are made, and since we're going to have a lesson on that today, the reason supply zones are made is where institutions, right? By institutions, I mean large orders, right? Retailers, we don't move the markets. Institutions move the market. Hedge funds, pension funds, things like that. Insurance companies that have a lot of investments, they move the markets. If they want price to go down, they have a set of orders that is sitting in the supply zone. When price gets away from that supply zone, they don't chase, right? They wait for price to come back. And when price comes back, it would be a large order, right? It's large enough, more than the bears, more than the bulls, that it drives the price down. And if those orders are fulfilled, the next time we come back there, price doesn't come back down, it shoots right through it. But when it comes back down, then there's quite a lot of orders still waiting up here to be filled. Now, usually when I have a supply zone and we hit it once, I take it off. I don't look at it. But part of the reason I didn't take it off is this supply zone only got taken off partially. It only got taken off partially. What I mean by that is if you are looking at the height of the supply zone, it was only about halfway through it. So I just left it. Maybe we still want to close it. Maybe there's still some orders up higher. But it looks like they didn't even want to go all the way up high, right? They just kept pushing the price down. Now, it's another thing to note, gaps are meant to be closed. We have a gap here that is not yet closed. I still have bearish bias in the market, right? I don't think we're done with the bearish move. So we're going to come and close this soon. So based on that, I'm not too concerned about this gap being left open. Sometimes you have gaps left open for 6 months, 9 months, a year, but they will come back and get it at some point. But today, because we have this supply zone, as soon as we rejected, the CPI was fantastic, right? It was great news, but it wasn't a huge news that will take the market to the upside and create new all-time highs, right? That wasn't that big of a deal. Somebody took action. They wanted price to come up here, and then they closed the gap. And as you can see, as soon as we close the gap, we reverse. Right. So this is why these
Uh,
gaps act as support and resistance. It's exactly. I mean, it's you know few
yeah.
pennies. I don't know exactly the point, but it's few pennies. If you look at the high of this is 398.93, and the low of this is 399.07, right? Within 10 cents. That's how
Mhm.
close it came. And boom, it reversed. What will it do tomorrow? I don't know. So far, futures are up, but I don't know what it will do tomorrow. So that's why you have to have context, right? It's not just we have good news and people who saw price gap up here and who bought here, they were clobbered. I mean, it didn't even take them an hour to lose their position because
Mm.
it immediately collapsed. So take everything in context, right? Everything in context.
Yeah.
Daily, weekly, those charts are important. In our daily, remember we saw the 78.6 is breached, which kind of made us think that we could go up higher for some short term period. Well, we're still struggling. We keep going, between both sides of that 78.6 multiple times. We go up, come down, go up, come down, go up, come down. We are up and we're starting to come back down. That's what it is looking like. So, not out of the woods yet in this bear market. And the bears are looking for a reason to take price down.
Mm,
Okay?
yeah.
So,
And
so
tomorrow
that's
we
that's
have
my
the Fed minutes,
yeah,
right?
yeah. We have
On interest rates.
Colonel Powell. He's going to speak tomorrow.
Yeah.
So we'll see what he does. Again, he wants to create recession, so he's going to drive interest rates up. And what was it? I saw something yesterday. I forgot the numbers, but when interest rates keep rising before they fall down, I think they said it's like an 18 months average, something like that. So he's gonna just keep taking it up
Mm,
until he gets the to control the CPI to the level that he wants.
yeah. What was the result today from CPI? Is it close to expectations or is it?
Yeah, it was close to expectations. What I like to look at is I go to Forex Factory and it tells you the big news, and if it's red, like it moves the market, it really moves the market. So
Yeah.
expectation was 7.3 and we were at 7.1 for
Mm,
year over year, and even month over month, 0.3, 0.1, which is pretty good, right? We're starting to see a decline. We want to
mm,
see this around between 2 and 3, right? That's the idea. But
yeah.
until then, that's why he's gonna keep interest rates up higher, which will impact real estate. It will impact uh, buying power,
Employment.
employment for sure. Well,
Yeah.
that's what he's counting on. If it impacts employment, then people don't have cash to buy.
Mm.
It will drive uh, inflation lower. That's just how they think.
Yeah, it's gonna be an interesting couple of months coming up, especially
Yeah,
one. I think it's gonna be a little bit of a shocker with all the companies getting ready to to kind of pull the trigger on riffs and headcount reduction and all that. So,
yeah, yeah. That's for sure. All right, so let's shift gear into uh, any uh, work that you guys have done. Like, have you guys done any homework, or do you just wanna go into the next session?
yeah, I think for me, I'd like to jump to the next session. And sorry, Beanie, my monitor broke, so I'm just on my laptop right now, so it's a little hard to see sometimes. But I
Okay.
think from that perspective, yeah, I would love to move on to the next session. I just had one quick question on gaps before we move on, because I did draw them, but I just looking at yours now. I just
Yeah.
want to make sure when you draw it, do you draw from like the wick, the bottom of the wick, or how do you draw it real quick just to understand?
So
And or yeah.
yeah, I think it's a pretty good question, but it doesn't have a very good formula, and I'll tell you why I said that. Like, uh,
Mm.
I'll give you a good example. By the way, remember last week when we talked, I said, hey, when this price went down, I took a position and I was expecting it to keep going down, and
Yeah.
it reversed, right? So the that Wednesday was good. Wednesday was pretty much a flat day, but Thursday, as soon as we opened with a gap up, even though we closed the gap throughout that first hour, as soon as we opened the gap up, I closed my position, right? I didn't want to,
Mm.
lose. I mean, I had a pretty good gain, but I didn't want to lose more than this amount, right? So if I had waited until, today, I would have been in a bad position, right? So sometimes you have to look at those. You got to make those decisions. But here's a gap on Friday, we gapped down. So I start so because I do it on the hourly, I start at the bottom. If it's a gap down, I'll start at the low of the last hour. Right, that's where
Is
I
that on
start the drawing.
wick, or does it
Sorry.
not matter? Is it on the wick or is it on the
So
actual?
a low is a low, right? There's no weak
Okay.
body. A low is a
Alright.
low, right?
Okay.
So it's usually. I mean, the reason I say it doesn't matter is sometimes you have just body, right? No wicks.
Mm.
Sometimes you have wicks, but it's a low, irrespective
Okay.
of what the bar looks like. And
Okay.
and so here's the tricky part. When the market opens initially, I don't have a weak high to draw it from. Right, this high I don't know it because it opened all the way down here.
Mm.
So usually, if I draw it, like if I'm able to see the market as it opens, I draw it to the open, right? Because I don't have this perspective yet.
Mm.
And then I'll say when this gap is closed, it's closed. Now, in take the contracts of that with today. If you look at today, so on the upside, you take the high of the last hour from the previous day, and when I saw it, the low has already been made, so I drew it to the low. But if you had not seen it and you had wanted to take it up to the open, that would have been fine. Right?
Mm.
Nothing wrong, right? But I just happened to see it down here, so I drew it down here. Irrespective, right? Wherever you draw it,
Mm.
the only thing that changes is the midway point. The bottom
Yeah.
doesn't change anyway, right? So, but because sometimes they only close halfway, right? It
Mhm.
could have reversed here, but it doesn't matter, right? Even if you had drawn it here, if you had known, uh, and then you say, hey, halfway is good enough, so halfway would be down here, and it would reverse. But actually, it didn't want halfway. It wherever you drew it, it went all the way to the bottom. It really wanted to close that gap.
Mm.
So again, the most important part is the last hour of the previous day. If you're on the hourly, the low or the high, depending on which side, and then the first hour, depending on what time you draw it. Right? It could be the high, it could be the open. Usually, if you see it at the beginning of the hour, it's the open,
Mm.
right? And then you see where the gap is.
Yeah. Do you always draw it on the hourly? The gaps?
Yeah, I do. Uh, it doesn't matter where you draw it really, but
Yeah.
I draw it on the hourly because on the daily I have to wait for that daily bar to finish,
Yeah.
right? Unless I just say, hey, I'm just gonna no matter what I draw it to the open, then that's fine. Then it doesn't matter which chart you use if you're gonna do the open.
Mm.
But if you're going to do the open, then on a daily bar, your previous day high or low is your marker. On
Yeah.
this in this particular instance, that last bar high happens to be the daily high. But there are
Mm.
days like in this one. So uh, if we look on December 1st, and if we do the daily, right? And if we do on this day, on the daily bar, you don't really see a gap.
Hmm.
You don't see a gap because where it closed is higher than the low, and where it gapped down is down here, but throughout the day it closed it, so you wouldn't really see it unless you say at the beginning of the day is when I draw it. So I'll draw from this low to the open, right? Unless you draw it something like this, then the daily is not important to me. Because I pull the trigger on the hourly, I draw it on the hourly.
Yeah, makes sense.
Yeah.
Okay.
Maybe you.
Thanks.
Any questions on from your side, like when you were doing your homework?
That makes sense. Yeah.
Okay. So now let's get rid of this. So just a quick recap, right? We know how to identify our zigzags. We know how to identify support and resistance. And our support and resistance, we're using now dynamic support and resistance through Fibonacci retracement, right? So this is what we've learned. And then we use Fibonacci extension to identify exit targets, not entry targets, but exit targets. Again, even the Fibonacci retracement gives you the exit targets because you can look at, hey, the negative 272 is my exit, right? You don't need the extensions, but the extensions for me, they're just one tool that says, I want to confirm that the direction that I'm going, like say, I see it do this, and if I have this entry, where is my possible exit? It's up here, right? In this instance. And you know what? This is, I just randomly selected this. What happened? That's what exactly where price reversed. Right? These things are they're real. They're magical. You have to put some trust in them, not just trade only on that. Look again. I choose another random spot. That's where it exits. So they really work. But so this is just to combine your entries and exit, right? If my exit is at the negative 272 and I put in the extension and it says, hey, I'm going to have a problem here, I better exit. It's already telling me previous moves, they move that much and then they struggle. So I better at least take a good portion of my position off and have a tighter stop where I don't turn the whole position into a losing position. So now that we have all this combined and we look at gaps, right? The gaps are not for entries, but they're for potential areas where price could have a struggle when we come back to that area. Right? It could be an area where price reverses to set up for an entry. Like it could, if it lines up with our fibs, it's perfect. Or it could be an area where if I'm taking a position toward a gap, I might struggle to go past it to my target. So I should consider exiting at that gap. When I say exit at the gap is, I love this trading view setup. You can add a middle part to it, right? And you can change the style. And now you know when it comes to halfway, that could be a potential exit, right? It doesn't always close 100%. 50% is considered close enough. So now as we combine this, what are major areas of support and resistance, right? This is where the idea of supply zone, demand zone comes into the picture. And there's additionally, there is also the idea of an order block. So these three things work together. So let's define each one. A supply zone is an area where there's a pressure to the downside, but institutions do not chase. So if they have a large order and only partially fill those orders, they don't say, hey, I will accept lower prices. They will say, okay, I'll keep the remaining of my position open. When price comes back there, I'll fulfill it and I'll get my full position. Right? If they're wanting to buy 1 million shares and only 200,000 gets fulfilled the first time, they still have 800,000 shares waiting to be filled. Right? That's where a supply zone is at the top. A demand zone is the exact same thing at the bottom. When they want to buy and they have those large orders sitting, they don't because they don't chase, only partially filled, so they wait for price to come back down. Question?
Yeah, I have a quick question. So when you say supply zone, that means, like you said, in your example, there's a bunch of buy orders sitting at that zone. Is that right?
No, sell orders. Supply is sell, right?
Sell orders.
Supply and
Sell
demand.
orders.
Just think of it in economics, right? Supply
Okay.
means there's a lot of things to be sold, right? And demand means there's a lot of things to be bought.
Okay. So normally in a supply zone, essentially that will drive the price down
Yes,
once the orders are filled, and then in a demand zone, it drives it up. Okay.
exactly. Why
Okay.
there's a supply zone means there's a lot of positions waiting to be filled up there. A
Yeah.
lot of institutions wanting to sell, but remember, they're not like us. They do not chase.
Yeah.
If their maximum entry is 424.43, it's not exact that figure, but somewhere around there, they are not going to sell at 424.42. They will wait for price to come back in this zone to sell. Same thing when they're buying. They will wait for price to come back down to this zone before they buy. Right? They don't have a sense of urgency to enter a position. They're not like us that says, oh, I need to have this much money by tomorrow. Therefore, I don't want to miss this opportunity. Let me keep chasing. Right? FOMO doesn't work with institutions. If they want 1 million shares, they will patiently wait for price to come to them. They don't go chasing price. So very, very critical to understand this. So the way you will identify them, we'll go into that deeper in a moment. But the way you identify them is everywhere you have your peaks and valleys, right? Everywhere you have your peaks and valleys, that's where you have your supply zone and demand zone. And how we draw them, we will go into that. But your turning points is what gives you an indication, right? We're looking for breadcrumbs for institutions to tell us what they are doing. That's what we're looking for, and this is what they give us, right? So that's supply zone and demand zone. Now, something else that works together with that is an order block, and that one is a little bit trickier. That one, it will also be at the top and bottom, but the way you will see it is when they want to take price up, they take it down first. They want people to keep thinking they want to sell, so they follow them. They want to sell with the institutions, and then when price is where they want it, they take it back up. Right? That's how institutions work. Every time you see a significant move to the one side, they take it to the other side first. So what do I mean by that? If you look at this area, this is a wick here. So I'm just going to move this to the side so you can see. So they opened here, they drove price up first, and then they collapsed it. If you look at this area, if the whole thing here, this whole 2 bars, they drove price all the way down first, and then they took it up. And this one, I want to encourage you and challenge you not to trust me, but to go look at the charts. Keep looking at the charts. You will see before price rises, they take it down first. Before price falls, they take it up first. It's not like it's falling, and all of a sudden it's going up. You see a significant last move where they take it down before they reverse. So pay attention to those. I don't draw them as much because they line up with my supply zone and demand zone a lot. Sometimes they're not the same, but I just rely more on the supply zone, demand zone. They're very close together. So because of that, I'm just going to focus our attention on supply zone and demand zone. I just wanted to give you the order block, right? And sometimes the order block is that the last high that you see, they moved it up. Like when you see a consolidation area, like this, when you see this consolidation, is they have already driven it up. Their intention is to drive it down, but they're playing around here to capture people on both sides. Right? People thinking, oh, they're gonna keep driving it up, they keep playing with them. People thinking they're gonna keep taking it down, they keep playing with them. There's a lot of manipulation, right? There's this manipulation that's happening, and then they take it to the real side they want to take. So pay attention to those things, right? This is how we're starting now to combine everything that we've learned. When we pull the trigger, we're combining those lessons. So because I have a lot of drawings in SPY, I just want one of you to give me a ticker, and then we'll just go through how I draw supply and demand. Let's just pick a ticker we haven't used.
How about Caterpillar? It's been my favorite stock lately.
Yes, CAD is beautiful. CAD is almost acting like a defensive stock right now.
It's almost at an all-time high, which is very surprising.
Yeah. So let's just randomly pick a moment here. I think it's good to go back and then see how they play out. Okay. So if we just start here, this is our starting point. This is our starting point. And we want to see where is the supply zone, right? This is a daily chart. So what I like to do is the last couple of bars, or if it's one big bar that's sticking out by itself, sticking out, right? It could be on the upside or to the downside. I just like to take it from the open to the high. You can take the whole bar wick to wick. I just like to take it open to high, and I have it extended all the way to the right because I never know when I'm going to hit this. It could be years before you hit this, right? So I keep drawing them, and again here you see these two bars that are sticking out by themselves from the open of the previous bar to the high there. Here's another one. Because I don't know, right? Because I don't know when I'm like this, I don't have any knowledge of what's happening. So I draw it as it's happening.
So do you measure like just, I guess, how did you measure exactly that rectangle?
I don't measure. I take the two bars that are sticking out to form that swing point, and I do it from the open of the left bar to the highest point of the two bars.
Okay.
It could even be just a single bar. If it's really a single bar sticking out by itself, let me show you an example of that. Like this bar is sticking out by itself. So I'll just do it from the open of this bar to the low of that bar. In this instance, they were like two of them too close together. That's why I just used both bars. Kind of similar up here. So I want to capture one side of my box captures the extreme tip, right? Whether it's up or down. The other side captures the open. If, like I said, if you want to capture the whole bar, it's not wrong, right? But I just think this is a little bit too wide. And I'll tell you why I'm worried when it's too wide. If price, if it's too wide, and price does this, I might be tempted that it is done, and it's gonna do this, right? I might be tempted. For me to remove my temptation, I like this a little bit narrower. And when price comes and doesn't touch it, I'll say there's still room to the downside. It doesn't always happen, but I want to give myself an edge all the time. Right? That's the purpose. I always want to give myself an edge. And if I have missed this move because this is how I drew it and I've missed this move, I'm fine. Right? So you have to be okay with your decision making. You cannot capture all the right moves, but you can get out of trouble more often than not, right? By making this kind of decisions. That's why I like the narrower. And if you see my templates, I have demand zone on the hourly, I have demand zone on the daily, even on the weekly. Right? So I want to look at different charts to tell me different stories. Sometimes when they don't line up, I want to see why they're not lining up. I don't remember the date now. Should have looked at the date first. So we need to go back to November 19, and we get that far here. So, as you'll see, it's good. It's good. We're almost there. Yeah. Okay. So here, on the hourly, you see it's not even this wide. So this bar here really is the one that is sticking out. So on the hourly, I'll just really adjust it this way, from that open to that low, and this is a 1 hour demand zone, right? This is a demand zone. So once I draw them and price starts to head in that direction.
How did you know it was a demand zone versus a supply zone right there?
So what is the criteria for demand zone and supply zone again? Demand zone is at the bottom, supply zone is at the top.
But this, I mean, if you don't know what's to the right, I guess you can.
No. I know what's to my left. I've come down. Right? And I don't draw it here. I have no idea there's a demand zone here. I only draw my zone once price is heading in the opposite direction.
I see. Okay.
Right? Price starts to move up, then I can say, okay, here's a demand zone. Now, this is actually a very perfect example of a demand zone. Down here, when you see this bar, you say, okay, let me draw my demand zone. And then what happened? That next day, this was a Friday, the next day, price came down to that demand zone before it took off. This is when you know demand was sitting here, they didn't want to chase it, they brought it down close enough. That's why I said close enough I don't take. Went up, some people were trapped to think, oh, it's close enough I take it, but then when they brought them down here, they might be stopped out. But for me now, I can feel comfortable. I'm in this zone. It's not fully, covered, but it's in this zone. When I'm in this zone, I'm comfortable. If it lines up with my fibs, I'm comfortable to enter. Right? Supply zone, demand zone.
Would you consider the one in late February a demand zone? You go back a little bit. That one right there.
So
Because you
yes,
keep down for a while.
absolutely,
Yeah.
right? Because why? Because price reversed.
Yeah.
Price reversed, so you draw it. Now here's an interesting thing. You draw it, you're waiting for it to come back down. It comes back down. Do you get a hammer, an engulfing, a railroad track at a significant area of value taken by a fib? If you answer yes to those, then you take this trade. Even if you were wrong taking this trade, it's okay because it fits your criteria. We haven't drawn fibs, right, to say this was an entry or not, but I'll tell you for sure. This is price is moving to the downside. I see a consolidation. I don't take it to the upside. Right? I just say, hey, this is a consolidation, and price could actually go down. But at least I have identified this demand zone, and I say, hey, you know what? Price could reverse here. If you know, but the problem with this one is price has been going down, continuously going down. Right? There's no fib that tells me it's time to enter.
Yeah.
Right? 78.6. Okay, if we draw this here, this bar here, this 78.6 up here, has to be broken first for me to say it's an upside. Right? But because this is not broken, I don't take it to the upside. However, it is a valid demand zone. Even very, very short term, people who understand demand zone but who do not line up other conditions to pull the trigger, they've pulled the trigger 1, 2, 3 times. But they got clobbered the next day because they did not follow other criteria. Right? So that's why. That's why you draw them and then you wait for them to happen. So here's how you think about where you draw them. For a supply zone, rise, consolidate, drop. That consolidation area becomes your supply zone. Drop, consolidate, drop. That consolidation area becomes your supply zone. Rise, immediately drop. That drop area becomes your supply zone. So if we reverse it to demand zone, it's drop, consolidate, rise. That consolidation becomes your demand zone. Rise, consolidate, rise. That consolidation area becomes your demand zone. Drop, immediately rise. That V area becomes your demand zone. Right? That's how you look at it. Like the 3 conditions on each side. And once you draw them, you're using them if they line up with your fib. Right? If they line up with your fib. So here's an example of what I mean by line up with your fib. Here's an area where you have a drop, a consolidation, and a rise. Right? So this consolidation area, and the width, you don't have to have it perfect. It's just an area I like to use, open to low when I do demand zone, open to high when I do supply zone. So here, right, when price comes down here, I want to go to the upside. That's my thinking. And do I collaborate that with my fibs? So this supply zone is actually in my sweet spot. Remember my sweet spot, right? Green to green. It's actually in my sweet spot. When price comes down here, do I get a hammer, railroad tracks, or engulfing? Or do I get a consolidation? That's what I'm looking for. I didn't get any of those. One is I didn't get really in that zone. And two, I didn't get those other conditions met. You could have said, I'm good enough with this consolidation, even though it didn't come inside here, it touched it, I'm good enough and take it. But remember, when you put everything in perspective, you have this price that failed to make a new high and it actually gapped down and it keeps going down. Are you comfortable taking this trade? You might say this is good enough, I take this trade. It's okay if it's wrong this time, if it fits your criteria, right? It's all about criteria. That's why you're journaling your trades, is to identify that the set of criteria you put together to pull the trigger works, right? If not, we make adjustments. But if this fits your criteria, this is where I said you make it align with your Fibonacci, right? Another zone here is here, right? Drop, consolidate, rise. So this area here is a good candidate. What happens? We come down to that 50%, still in my sweet spot, right? We didn't come down. This one is not close enough if you skip this one, but this one, it's actually inside the zone at 50%. And here's the consolidation area. If you say this area is consolidation, and as soon as we break above it here, we take the trade 112.74 to 116.95, but you don't hit your targets. Again, you should be concerned. High, lower high, lower high, then you probably just exit, right, for a small gain. But again, we line it up: supply zone, demand zone, right? We line them all up, and when price has not gone there, like here, boom, it comes back down and price collapses, I no longer need this because it's no longer a demand zone, because price now, a demand zone cannot be higher than current price, and a supply zone cannot be lower than current, right? It becomes the opposite. So here, remember we have this drawing here. So what happens over time? Boom. We come there, we pretend that we filled our orders, we come back there, we collapse, right? This is why these are really extremely important to put in place. The fib by itself is not enough. That it could be a good place for you to take your exit. If you had entered a position and you said, hey, here's my exit, -272, -618. Look, we hit exactly that and we collapsed. If you had taken a trade here, right? This is the maximum you could exit. Why? This is the maximum you could exit because it's a supply zone. You should have exited on this bar here. February 5th bar at 6:30, you should have exited, not waited until the June 8th bar, right? No, June 5th, not February. June 5th and June 8th. June 5th, you should have taken your exit because we got to this zone. It blew past your exit 1, exit 2, I'm out because I have identified this zone. Right? So it's important to look at those, look, they're not done when they keep hammering it. They keep hammering it because they're not done yet, right? So they still want more money from this downside, and then they finally give up when it blows through it. But it hit it once, second time fully inside. I'm not worried about this guy anymore. I'm deleting this. When this happens, I'm not even seeing that. When this happens, I have most likely I have drawn it again here in this area. Right, I've drawn it again here. Look, collapses. It hits it fully, collapses. Next time it struggles. So I like to draw them because I'm not seeing what's on my right side, right? So I'm drawing them for you without seeing what's on my right side. One hour delay. So look here. Price doesn't come down to this zone, but it touches it, collapses, it almost completely collapses. After it covers it, completely collapses. And so, two things to keep in mind when we come to that supply zone and we see a shallow pullback, we see even a shallower pullback, don't count on entering another position to the downside. Because at this point, they're struggling already. They're not wanting to take it further down. Or bulls are stepping up, right? Bulls, but not just retailers, institutions are stepping up. So take that into consideration as well, right? If this starts to get shallower and shallower, it means we're gonna blow right past it. Again, what happened here? We went through it, collapsed. Right? Again collapsed, again collapsed. Again, we can't collapse, we are above it. So that's why you have to keep them in place, right? From June 2020 until September 2020, right? A few months, you have to keep them in place until price comes back down and tests it. And if you keep drawing them on all your charts, sometimes you'll be surprised. You know, price was going down for 2-3 years. It comes back to that zone that you drew 3 years earlier. And if it struggles, you know why. Because that's where you had your supply zone. Before you get there, you know to exit if you have a position. At least remove majority of your gains and play with a smaller amount, right? So you know those things because of that. Then once it's out of the way, you move it out of the way. There's still some down here we have not touched. There's still a supply zone down here, a demand zone, I mean, down here. So you keep drawing them, and I'm not going to keep drawing them, but I just want to keep us going this way to see if we ever come back down to what we drew earlier. But we're going to eventually come down to it. Maybe this one hasn't decided to come down that low. But you see how we keep bouncing up and down, up and down? But those areas that you draw, you just, so here's some that we drew, we just keep leaving it there. And then here's an area here that you draw. Remember to take care of that. Here's your supply zone here. So here's the supply zone. We're coming very close to that. So if you take a position, you want to be careful in this area. And then when it comes back down here, we want to pay attention to what's happening. So this is now, I think we've added everything that we needed to add. And from here on out is looking at every chart and say, why did I miss a trade? Because now we have everything we need to be able to pull the trigger. There's nothing missing. So every session from here on out, what I want to see is, hey, I put everything together. Here's a trade that I made. Paper trade, right? Remember that, paper trade. But here's a trade that I made, and here's why I made that trade. And the one thing I will tell you to make it easy, only focus on a few tickers. Don't focus on trying to find a trade on from a list of tickers. You'll get an opportunity weekly. Just focus on a few. And you can have fun, right? You can have fun and select, big ticket stocks, like stocks that are trading more than $400-$500, or you can find stocks that are trading, $100. Doesn't matter. When you're paper trading, don't worry about the stock size because you have unlimited cash, right? So just pull the trigger. Just say, hey, draw your fibs, draw your uh, supply zones, demand zones, your gaps, right? Your gaps now really become important here. Here's your gap on the daily. This has a significant gap on the daily. What is going to happen when price comes back down here? This gap is going to act like resistance. It's going to act like support, right? In this instance, it's support because price is coming back down. And then we have an additional, rise, consolidate, rise. So we have this area again of demand zone. So what happens when price comes down to these levels? Got to pay attention to those. Right now, our closest is the supply zone. The closest thing we have to worry about. But then what happens when we come back down? So that's your homework now. Put everything together and every week pull the trigger. And I want to give you a couple of weeks to do that and journal. Let's just take a couple of weeks break because holidays are coming. When I say let's take a break, is I take a break because you guys gotta do homework. And then in January, let's look at your journals, right? And of course, you know how to reach me. If you have questions in the meantime, if you want to go over something, let's do it. Let's just get together and do it.